Good afternoon, Mr. and Mrs. Hess. Welcome back. Thank you so much for taking time out of your day to meet with me, and I hope you had a great vacation in Europe. And I cannot wait to hear about the favorite places you went to. My family had a vacation in France 4 years ago, and we all loved it, especially the food, wine, and other museums. I'm sure you will have a lot to share as well. So, congratulations to Mr. Hess on your retirement and the sale of your manufacturing business. Congratulations to Mary as well for your retirement last year as a high school teacher. I know both of you worked very hard to get this point, and now is the time to relax and enjoying your retirement life. So we want you to be worry-free from financial perspective, and that's why we're meeting today to make sure everything is in place. After our initial meeting, thank you both so much for collecting all the financial data for me and fill out the questionnaires and forms. I know this is a lot of work, but this helped me to analyze your current financial situation. Therefore, we can make proper recommendation based on your goals going forward. We also made a copy of this comprehensive financial plan that we are going to go through together today. I hope you had a chance to review them. But if you did not have time to do so yet, that's okay. I will walk you through together. Please feel free to stop me anytime, and I would love to help you with any questions. So first of all, let's go over your financial goals again. Your financial goals were identified and prioritized as follows. Number 1, reduce any gift and estate tax liability and ensure all estate planning documents are in order. Number 2, review insurance contracts and discuss the implications of purchasing a long-term care policy. Number 3, reduce personal income taxes. And number 4, based on your moderate high risk tolerance level, recommend a diversified portfolio that meets your investment needs and expectations. So our comprehensive financial plan consists altogether 6 sections, which include financial health, risk management, investment planning, retirement planning, income tax planning, and estate planning. So we will address your additional financial requests with your main goals for each of sections. We will conclude with a planned to-do list, which identifies the actions items need to be implemented, the most essential planning recommendations. Also, I want you to be sure that you're clear about the following fact patterns and assumptions that we used to put together for your analyze. Your current marginal tax bracket is at highest federal rate, which is 37% in 2021. The current inflation is at 2.25%. So the inflation rate refers to an increase of price of goods that can affect your purchasing power in the long run. The risk-free rate is at 1%. So this is basically what you can expect out of a risk-free investment. Think of a 91-day treasury bill stands at about 1% return rate. However, we forecast that both short-term and long-term interest rates and inflation looks to increase in your retirement years. We also used 7% as the market risk premium, which is the difference between the expected return on a market portfolio and a risk-free rate. Okay, so let's go ahead and dive into your current financial state. Excited? Great. So number 1, your financial health. The documents that we're providing here include the statement of financial position, which is the balance sheet, the ratio analysis, and statement of cash flow. So first of all, I would like to congratulate both of you for being so successful with your careers and being excellent saver. Your current financial situation shows net worth about $12.8 million, and your net disposable income of 1.28 in current year. So all in all, you are in a very good position going to retirement. And with such sizable savings, a strong disposable income, you can meet your financial goals set up by yourself very easily. So one note to draw your attention is that your current disposable income is much higher than ordinary year, because John received $1 million down payment plus 10 monthly installment payments from the sale of his business. And going forward for the next 7 years, the total installment payment will be about $440,000. So please keep this information in your mind. In addition, we calculate financial ratios that measure your financial status compared to benchmarks. So we discovered that you'll have a very high current ratio of 14.15. So the current ratio is calculated by comparing your current assets. Yes, Mrs. Hess, you can find this current assets on the balance sheet, $850,000, to your current liabilities, which is $21,169. So in general, we can say that a current ratio that is 2.1 or greater is usually a sufficient benchmark. In your case, due to this very high current ratio, you are very liquid and can certainly cover any current liabilities that you have. Your current emergency fund is significantly higher than the 3 to 6 months expenses amount that is typically recommended. Due to the significantly high current ratio and excessive emergency fund, we recommend reducing your emergency fund down to about $185,000, which equals 6 months of your expenses. We also did a calculation for your cash surplus. We come with a number about $325,000. So what we did is we used the total cash available now, which is $850,000, by subtracting $40,000 cash needed for your new car. I know Mr. Hess is very excited about this new car. And the $185,000 emergency fund that we recommended here, and then the estimated income tax liability for 2021 of $300,000. So we recommend reallocating the surplus of $235,000 from your current CD account into your mutual funds portfolio, which have much higher investment return rates. This will help you to accomplish the goal of maximizing your diversification of your investment portfolio based on your moderate high willingness and ability to take on risk. Additionally, we recommend using the rest of the cash surplus to strengthen other areas of your financial pictures. So those areas include paying off various credit card balance in full, so you don't have to worry about it anymore, contributing to your grandchildren's 529 plan accounts, which we'll cover in more details in the income tax session, and purchasing a comprehensive long-term care insurance. Besides that, we often bring some other ratios for housing cost and debt ratios for our clients, but because you do not have a huge amount of mortgage or any rental, we're not going to address those ratios now. So to get our recommendation down at the end of the 1 year term of your 800 CD, so invest about $235,000 in mutual funds, including growth mutual fund, international mutual fund, and the balanced mutual fund. Set up 529 accounts for your grandchildren. So do you have any question for this session? Great, let's move on. Second, we're going to discuss your risk management. So a scenario was prepared to identify any weakness in your insurance coverage regarding your homeowners policies of your primary home and vacation home, your auto, and the health insurance policy. In addition, we will discuss the implication of purchasing a long-term care policy. So currently, we noticed that your primary home is underinsured. What does that mean? So the homeowner policy for your primary residence needs to be at least 80% of 775,000, which equals to 620,000. So at here, 775,000 is the fair market value of the building of your primary home. The current policy provides only 400,000 of coverage, which represents a shortfall of 35,484 100,000 loss after 500 deductibles. So we recommend increasing homeowner insurance policy to 620,000. At the same time, you can increase your deductible as well. So by doing so, you can make sure that your home will be fully covered, while the premium increase will not be a lot. The rest of insurance, including vacation home insurance, your health insurance, and your personal auto insurance, looks all adequate. However, due to your high net worth value, we recommend purchasing a personal umbrella policy, which will cover above and beyond your other policies provide. The recommended policy for this insurance is about $10 million. That will cover the gap between your other policy and your net worth. We also recommend adding a rider or endorsement to your homeowner policy to cover your boat and the stamp. Okay, next, health insurance. I know this is very important to both of you. So currently you're covered by Medicare Part B and Part D, which is great. And also we can suggest that you apply for Part A as well to cover any future hospital and skilled nursing care expenses, which you do not have to pay any additional premium. Next, we're going to discuss about something about a long-term care policy. I know that you mentioned that you would like to discuss the implication of purchasing a long-term care policy. So we recommend a policy that would cover both John and Mary, so each spouse would be able to share your benefits. The benefits will be paid up to 3 years or 360,000, whichever comes first. The annual premium will be $5,200 for John and $4,000 for Mary. So the premium are medical expenses that you can be potentially deducted on your Schedule A of your personal return, provided that you itemize your deductions and all the medical expenses exceed 7.5% of adjusted gross income. We can discuss about this later when we talk about income tax as well. So to follow up, I think you need to set up a meeting with your current insurance agent. I believe you work with Larry Smith, the insurance, and who you got our name from. We worked with him very well. And just in full disclosure, we will get a commission from him if you choose to use our services. Please, you can meet with Larry to update your homeowner policy, getting an umbrella policy, and adding a rider to the stamp and the boat as soon as possible. Also, you can discuss with Larry about the potential for buying this long-term care insurance. Any questions? Good. Let's move on. Next, investment planning. So here we have provide investment policy statement and an analysis of investment portfolio. Currently, your investment includes both qualified and non-qualified accounts. The non-qualified accounts include stock portfolio and a mutual fund portfolio. The qualified accounts are the accounts that received tax benefits that you did not pay any taxes for the dollars that you put into those accounts. So those accounts include 401k for John and 403b for Mary. So let's discuss non-qualified account first. As we can see now, there are only 4 stocks in your stock portfolio, and the stock A has dropped dramatically. I believe you noticed this as well. Okay, that's fine. I mean, when we talk about investment, you will have gain and you will have loss. That's very normal. But the other 3 stocks are doing very well. In total, the stock portfolio is underperforming the market. So our suggestion is to liquidate stock A in 2021. By doing so, you can generate about 218,000 of long-term capital loss. So just keep one thing in mind. John just sold the business and it generated a lot of long-term capital gain. So when you liquidate stock A, the loss can help you to absorb some of the long-term capital gain from the installment sales of the business, which eventually will help you to reduce your current year income taxes. After 2021, so you can liquidating your existing stock portfolio in favor of a largely diversified portfolio comprises stocks, bonds, and other assets class, and match your above average risk tolerance level. Also, we can see that your mutual funds portfolio and both of your qualified accounts, 401k and 403b, are performing very well and well diversified. One note for Mary's 403b, the account is currently allocated to a 2025 target fund. So what does this fund do is usually it's designed for the people who are targeted to retire in year of 2025. So we know that Mary, you already retired last year. So we think this account should be reallocated to a fund that represents Mary's status and reflects Mary's investment preference. Finally, as we mentioned in the prior section, we encourage you to invest a remainder of the down payment into your mutual fund portfolio to increase that portfolio a little bit. So our team will develop an asset allocation strategy for you to maximize your return in a tax-efficient manner, and we will certainly stay away from any direct or indirect tobacco investment to make sure of this special requirement from you, which is very important to you. I'm sorry to hear that both of your parents passed away because of lung cancer. I personally had a very close family member died from lung cancer too, so I totally understand your concerns and the requirement, and we will make sure this be taken care of seriously. If you have no more questions, then we can move on to the next session. Let's talk about the retirement planning. So here we have a retirement plan analysis was conducted for both of you and attached. We know that both of you are entered retirement phase and your current financial position is meeting your retirement goals. So we're running the numbers to make sure that your asset is enough. So we made this conclusion by using a return rate of 8.5% and the inflation rate of 2.25. If you want to be more conservative by using a lower return rate of 6%, a higher inflation of 4%, you still have more than enough assets to cover your retirement goals. So you don't have to worry about your retirement funds. Also, John had 11,000 earned income in 2021. So we can just let you know that the maximum amount that both of you can contribute to your qualified retirement account is 11,000 for 2021. Our recommendation is you contribute this 11,000 to a non-deductible traditional IRA account, then roll over it to a Roth IRA account in 2021. So the asset in this Roth IRA account will grow tax-free, which will agree with your goal of reducing your personal income tax. In a few years, once you turn to 72 years old, you will be obligated to take a required minimum distribution from your retirement accounts. That will impact your cash flow and increase your taxable income. So we also recommend you to converting part of your 401k and 403b account investment to an RA account. The reason for that is when you turn to 72, you can reduce your adjusted gross income by making qualified distribution from your RA account up to 100,000 for each of you per year to offset the income increased due to the required minimum distributions. So which is very powerful, and this can only be done by RA account. So 401k or 403b cannot do so. That's why we are suggesting you to converting from your current retirement plan to a RA account. Our team will assist you to set up an RA and a Roth IRA account, and will guide you for the rollover. As you also expressed your willingness to grow a 401k tax-free and distribute the maximum amount left in the account to your 2 children upon both of you passed away. So this can be done by converting your current retirement accounts to a Roth account. But due to your income level, we do not recommend you to get this conversion done now, because when you do conversion, you need to pay the tax. When you're converting the part of the amount from your traditional account to the Roth IRA account. But we will keep monitoring the income tax rates and also your taxable income to help you determine if there is any need to convert your traditional retirement account to a Roth. Okay, so this covers all about retirement planning. Any questions? Great, I'm sure you will have questions later, but don't worry, you can always reach me out later. Then let's talk about income tax planning. So tax calculations for installment notes and analyze for tax implication for selling or donating 1918 inverted Jenny stamps attached here. So that's very exciting. We're going to talk about this very special stamp. Great. So let's revisit the numbers again here. John received $1 million down payment for selling his business in February 2021, and a monthly payment in amount of $36,567.83 has been scheduled to pay out in 80 years. Total long-term capital gain for selling the business for 2021 is about $1 million, which including $731,250 from the down payment, $1 million down payment, and $269,699 from the monthly payments. So currently, the federal income tax rate for long-term gain is 20%, but on top of that, you have to pay 3.8% of net investment income tax as well. The interest portion of the monthly payment in 2021 is about $95,979. This income will be taxed as ordinary income, and your total tax rate for this interest is at 47.8%. Which is 44% of federal and state marginal rate plus 3.8 net investment income tax rate. I know that we're talking about a lot of tax dollars here, but I just want you to understand that you're paying tax because you earn the money. And also, we covered about suggesting to liquidate stock A to generate the capital loss to absorb part of your capital gain for selling of the business. That would definitely reduce your tax liability a lot. So I hope that we can, at the end of the year, we can just put all these numbers together and you will get a clear picture about how much tax you're going to owe. Okay, so let's move to John's 1918 inverted Jenny stamp. I'm very excited to discuss about this. I know that, John, you are very lucky to have this inheritance from your parents. Um, that's very interesting. And let's talk about the tax implication of this stamp now. So, first of all, the adjusted basis is 725,000 and is expected to increase in value by approximately 8% per year. So, John, I know that you are planning to sell this stamp in 10 years from now on for 1.55 million. So the estimated gain is about $567,500 after 15% commission. So we should let you know that the federal income tax rate for this stamp is there is a special tax for collectibles, which is 28%, plus the net investment income tax, which is 31.8%. Also, you need to pay state income tax as well. So altogether, it's almost 40% of income tax rate for selling this stamp. So our suggestion to avoid this high income tax rate is transfer the stamp to a charitable reminder trust that can pay your income for life and will eventually benefit a charitable that you choose. You will receive an immediately income tax charitable deduction when this trust is funded, based on the present value of the stamp. Because the trust is irrevocable, so this stamp will be removed from estate and for estate tax purpose. This will help you to achieve your goal of reducing state tax and your personal income tax as well. So we recommending utilizing the 15,000 annual gift exclusion per person per donee to fund your grandchildren's 529 plan. So I know that I will make your grandchildren very happy. By selecting gift split, both of you can contribute up to 90,000 for all of them. So finally, we suggest to continue to invest the rest of the cash surplus to bonds, especially municipal bonds, which has no federal tax liability. So we're going to revisit your taxable income and tax liabilities in an annual basis to make sure that you will pay your estimated tax in a quarterly basis and avoid late payment penalties. Also, we will set up the follow-up meeting to discuss the potential needs to set up the charitable reminder trust if you are interested in. Any questions? Great. Finally, we're going to talk about estate planning. So this is our last session. I know it's a little bit weird to talk about this, but you should know that you're not alone. I know how much you care about your kids and your grandkids, and I hope that the asset you accumulated can pass down to them and your goal will be met. So that's why we're meeting today to discuss about this topic. So here we have a property ownership spreadsheet and estate tax calculation prepared for each of you and attached here for you to review. So at this time, Mary's gross estate is 1.5. It's about 1.5, and John's estate is a little bit more than $10 million. So under current tax regulations, the federal estate tax exemption for married couple is 23.4 million and 11.7 million for each of you. So therefore, each of you has a state tax that is subject to state tax. So which is great. However, we want to address that a significant problem is that each state is subject to excessive parades, fees, and expenses. So now the estimated expenses is about 250,000 per each state. The other concern is the current exemption amount may be sharply reduced soon. The Biden administration proposal would reduce the exemption to 3.5 million for assets transferred at the time of death and just 1 million for gifts made during your lifetime. So we need to keep watch those proposals. I know that you have a will, but we noticed that there is no essential estate planning documents in place, such as power of attorney and healthcare proxies. So we want this to be in place as well, which is important for you, just to make just in case something will happen. So our recommendation would be we can do anything by passing parade. So we want changing the titles of some assets that is under your sole name, sole ownership. So if you check the asset property statement, any assets marked as H is under John's name, and any asset is marked as W is under Mary's name. So we're recommending changing all those sole ownership, including CDs, mutual funds, portfolio, installment receivable, vacation homes, autos, boats, and the stamp from sole ownership to tenancy by the entirety to avoid parade costs. So this change would automatically transfer the properties to the surviving spouse at the first spouse's death, which is compatible with your objectives. Also, we recommend updating your qualified retirement plan account's beneficiary to the spouse and to your children prospectus. If any of your children, so what does that mean is if any of your children passed away before you, then their inheritance will go to their children. We encourage work with your you're going to work with your estate planner to put all those documents needed in place. So please make sure to make appointment with the estate planning attorney as soon as possible. If you do not have one, we can certainly refer one for you. Also, we want to assess your state assets on yearly basis to cope with your potential changes for the state tax exemption amount. So to summarize, the recommendation that we're giving to you today are not it's not going to be very difficult to put in place, and you're already in a very great place for retirement. But just to summarize, we still want to address the following action plan to make sure your goals will be met. So first, to visit the estate planning attorney as soon as possible to obtain the proper estate planning documents. So do it as soon as possible to including your to set up your power of attorneys and healthcare proxies. Secondly, setting up a meeting with your current insurance agent to updating your homeowner policy and adding an umbrella insurance policy and a long-term care insurance policy. Third, at the end of the 1 year term of your 800,000 CD, investor about 235,000 in mutual fund, including growth mutual fund, international mutual fund, balanced mutual fund. So gift 30,000 to each of your grandchildren. Finally, the fourth one is diversify your stock portfolio and to liquidate your stock A. So our team will develop an asset allocation strategies for you to maximize your return in a tax efficient manner. So I know that we covered a lot today, but I will be your trustful retirement planner. Please feel free to reach out if you have any questions or any material changes of your financial situations. Thank you again for taking time to meet with me today, and I hope you found this helpful. Looking forward to work with both of you to accomplish all of your financial goals. Take care and have a great evening.